I've spent 50 years listening to people tell me that this time is different. Every time a new gadget or a new piece of software comes along, the geniuses on Wall Street act like the laws of economics have been repealed. They start talking about new paradigms and exponential growth curves as if they've discovered a way to make the sun rise in the west. Well, I'm here to tell you that the sun still rises in the east, and if you can't find the supply and demand equation in whatever you're doing, you're not investing or hallucinating. Right now, everyone is losing their minds over artificial intelligence. They're treating it like a religious experience instead of a business tool. But I've seen this movie before. I saw it with the mainframe, I saw it with the PC, and I saw it with the internet. Every one of those things was a massive breakthrough, and every one of them led to a period where people forgot how to count. They stopped looking at free cash flow and start looking at clicks or users, or in this case, compute power. It's total nonsense. At the end of the day, I don't care how smart your machine is. If it doesn't help me create a barrier to entry or lower my cost of production in a way that my competitor can't immediately copy. If everyone has the same AI, then nobody has an advantage. It's just another cost of doing business, like electricity or running water. And if you're paying a massive premium for a company just because they have AI in their name, you're probably the one providing the liquidity for someone else's exit. I'm a pragmatist. I'm the guy who dances on graves because I wait for the moment when the hype dies and the reality of the balance sheet sets in. And believe me, the graves being dug in the AI space right now are going to be deep and plentiful. But for the few who actually understand how this technology shifts the physical world, the world of steel, land, and energy, there is a massive distortion forming. I'll tell you exactly where that distortion is by the time we're done here, but first, let's get grounded in reality. You want to talk about AI? Let's talk about the one thing AI can't invent: land and the power that sits on it. Everyone is obsessed with the software, but nobody is looking at the plumbing. AI requires a staggering amount of energy and a massive footprint of data centers. Now, what does Sam Zell look for? I look for scarcity. I look for things that are hard to build. I look for replacement cost. If you want to build a data center today to house these high-powered chips, you can't just snap your fingers. You need power, massive, consistent 24/7 baseload power. And in case you haven't noticed, the world is currently having a nervous breakdown about how to generate electricity. Between the regulatory hurdles, the aging grid, and the push for renewables that aren't ready for prime time, getting a new connection to the grid is becoming a Herculean task. That's a barrier to entry. That's where the margin is. I don't want to own the AI that writes poems. I want to own the building where the server sits, where I have a long-term contract for power that someone else can't get. That's skin in the game. That's understanding the difference between a fad and a fundamental shift in infrastructure. When the capital starts chasing the shiny object, the software, they leave the boring stuff behind. They leave the physical assets underpriced. Look at the demographics of the workforce. We've got a shrinking labor pool in almost every developed nation. If AI can actually replace a mid-level bureaucrat or a data entry clerk, what does that do to the demand for office space? It's not a pretty picture. We're already seeing the carnage in the office market because of remote work. AI is just another nail in that coffin for the commodity office building. If you own a mediocre building in a mediocre city where the tenants are all replaceable by a sophisticated chatbot, you're in a world of hurt. You're looking at a terminal value of 0. But if you look at the other side, the longitudinal strategy, you see that AI might actually make human talent more concentrated. It might make the winners in certain industries even bigger. And those winners will want the best space, the best locations, and the most secure environments. The gap between the best and the rest is widening into a canyon. I've always said that I'd rather own the best house in a bad neighborhood than the worst house in a good one. But in this new world, you want to own the gatehouse to the neighborhood everyone is trying to get into. The problem with most of these AI startups is that they have no moat. They are burning through cash, subsidizing their growth with venture capital, and hoping that they can achieve some kind of monopoly before the money runs out. But there's no friction in software. Someone in a basement in Bangalore can write a piece of code tomorrow that makes your billion-dollar foundation model look like a typewriter. In real estate, there's friction. There's the permit process, the environmental impact study, the steel, the labor. Friction is my friend. Friction protects my rents. I see people valuing AI companies at 50 times revenue, not profit, revenue. It reminds me of 1999. Back then, they told me that the new economy meant that earnings didn't matter. I told them they were crazy. I stayed liquid, I waited, and when the bubble burst, I bought the assets for pennies on the dollar. Liquidity is equal to value, especially when the music stops. And the music always stops. Usually, it's when the Fed realizes that they've let the party get too rowdy and they start taking away the punch bowl. We've had years of artificially low interest rates that have distorted the price of everything. Now that we're back to a world where money actually has a cost, the asymmetric risk of these high-flying tech bets is becoming clear. If the AI doesn't deliver a massive increase in productivity within the next 24 months, the capital is going to flee. And when it flees, it's going to leave behind a lot of expensive hardware and a lot of empty promises. I'm looking for the distressed play in AI. It's not going to be the companies themselves. It's going to be the secondary and tertiary effects. For instance, what happens to the supply chain? What happens to the emerging markets that have built their economies on outsourcing and process management? If AI takes those jobs, those countries are going to face a massive demographic crisis. But where there's crisis, there's opportunity. Maybe the opportunity is in the repatriation of manufacturing, what people call nearshoring. If AI and robotics make labor costs irrelevant, then why would I manufacture anything in China? I'll build a highly automated plant in Mexico or right here in the States close to the customer. That shifts the demand for industrial real estate in a way that most people haven't even begun to model. They're too busy looking at NVIDIA's stock chart to realize that the real play is in the logistics hubs of northern Mexico or the Inland Empire. That's what I call following the scent. You don't look at the fire, you look at where the smoke is blowing. And let's talk about the cost of replacement. In the tech world, the replacement cost of software is often near zero. In my world, the replacement cost is everything. If the price of an asset drops below what it would cost to build it from scratch, I'm interested. Right now, the intellectual property of AI is being priced at a massive premium over its replacement cost. That's a bubble. On the flip side, the physical infrastructure that supports this technology is often priced below its replacement cost because people don't understand the constraints on power and cooling. I've always been a big believer in simple. If a deal is too complicated to explain on a napkin, it's probably a bad deal. AI is the ultimate complicated deal. It involves black box algorithms, massive capex, and uncertain regulatory futures. Who's going to own the liability when an AI makes a mistake? The insurance companies don't know. The lawyers are salivating. That's a massive hidden cost that isn't being reflected in these valuations. I want to see the free cash flow. I want to know who is actually paying for this stuff and whether it's making them more profitable. So far, the only people making real money in AI are the ones selling the shovels, the chip makers and the cloud providers. The people digging for gold, most of them are just getting muddy, and eventually they'll run out of money to buy more shovels. That's when the shovel sellers get hit. It's a classic cycle. In every cycle, there's a moment of peak stupidity. I think we're close to it. When you see AI-powered toothbrushes and AI-driven dog food, you know the marketing departments have taken over from the engineers. As an investor, that's your signal to tighten your belt and check your exits. I've never been afraid to sell too early. I've made a lot of money by leaving the last 10% for the next guy. Let him take the risk of the peak. I want to be the one with the cash when the grave dancing starts. You have to remember that I'm a buyer of utility. Does this thing provide a service that people need and are willing to pay for? AI has the potential to provide incredible utility, but we have to separate the utility from the hype. It's like the telephone. The telephone changed the world, but not every telephone company was a good investment. Most of them went broke. The ones that won were the ones that controlled the wires, the barriers to entry. I'm looking at the global landscape, and I see a lot of zombie capital that's just looking for a home. It's scared of inflation. It's scared of geopolitical instability, so it rushes into whatever is trending. That's the most dangerous kind of capital. It's dumb money, and dumb money creates the very distortions that I love to exploit. The dumb money is currently obsessed with AI. They are pushing valuations to levels that assume everything goes perfectly for the next 20 years. In my 70-some years on this planet, I can tell you nothing ever goes perfectly for 20 years. The real test for AI will be when the skin in the game comes into play, when a CEO has to decide between making his quarterly numbers or investing in a massive AI integration that might not pay off for 5 years. Most of them will fold. They'll do a light version of AI to satisfy the analysts, but they won't do the hard work of retooling their businesses. That's where the asymmetry is. There will be a few companies that truly transform and a whole lot of others that just use it as a buzzword while their margins get eaten alive. I'm also watching the emerging markets very closely. People think AI is only a Silicon Valley story. They're wrong. AI is a global story because it's a productivity story. If I'm in a place like India or Southeast Asia and I can use these tools to leapfrog the traditional development stages, that's huge. But again, you need the infrastructure, you need the power, you need the fiber optic cables, you need the things that Sam Zell likes to own. I'd rather own the fiber optic network in a growing city than the software that runs over it. The software is fickle, the cable is a monopoly. There's a lot of talk about risk with AI, extinction risk, job risk, all that. I look at regulatory risk. Governments are slow, but when they move with a heavy hand. They are going to look at these massive AI companies as natural monopolies, and they're going to regulate them like utilities. That's the end of the high margin dream. If you're a utility, you get a regulated rate of return. You don't get a 100x multiple. People aren't pricing in the political risk of the backlash against AI, but I am. The problem is that investors have become addicted to the virtuality of it all. They forget that even the most sophisticated algorithm in the history of mankind eventually has to touch something physical. It has to reside in a server that sits on a floor, that is cooled by a fan, that is powered by a wire. And that wire, my friend, is where the real war is going to be fought. We are heading into a massive collision between the unstoppable force of AI demand and the immovable object of our physical infrastructure. If you look at the power grid in this country, it's a relic. It was built for a world that doesn't exist anymore. Now, you've got these tech giants who have more cash than some small nations trying to secure every megawatt of power they can find. They're buying up nuclear power capacity. They're building their own substations. They're trying to bypass the traditional utilities. Why? Because they know that without power, their billions of dollars in H100 chips are just very expensive paperweights. This is a classic supply-demand squeeze, but it's happening in a sector where the barriers to entry are governed by the government, not the market. That's a recipe for a massive price spike. I've always said that I want to be where the scarcity is. In the 90s, the scarcity was in high-quality apartments. In the 2000s, it was in emerging market office space. Today, the scarcity is in power-ready land. If you own a parcel of land that has a 500 megawatt connection already approved, you don't just own real estate, you own a license to print money. The tech companies will pay almost anything for it because their opportunity cost is so high. If they can't train their next model because they're waiting 3 years for a transformer, they lose their competitive edge. In that scenario, my land isn't worth its market value anymore. It's worth whatever the value of time is to a trillion-dollar company. But let's look at the asymmetric risk from the other side. What happens if the AI bubble bursts before the infrastructure is finished? We've seen this before with the telecom boom. In the late 90s, they laid enough fiber optic cable to circle the Earth 1,000 times. Then the crash happened, and that fiber was worth 5 cents on the dollar. I bought a lot of it. I bought the companies that owned the pipes when they were in bankruptcy. That's grave dancing. Right now, we are seeing a massive overbuild of data centers. Every developer and his brother is trying to build one. They're taking on huge debt, betting that the demand will stay parabolic forever. If the demand levels off, if companies realize that a good enough AI is sufficient and they don't need to spend billions on the next version, you're going to see a lot of half-finished data centers looking for a buyer, and that buyer is going to be someone like me. Someone who isn't emotional about the technology, but knows exactly what the steel and the copper are worth. I'll buy them for below replacement cost, and I'll wait. I've made more money by waiting than by doing. You have to have the stomach for that. Most people can't handle the silence of a dead market. They need the noise of the crowd to feel safe, but if you're doing what everyone else is doing, you're destined to get the same mediocre results, or worse, you'll be the one providing the exit for the guy who was smart enough to get in early. I look at the current AI landscape and I see a lot of people chasing the stock, chasing the trend, chasing the prestige. When you're chasing, you're not looking at the ground, and when you don't look at the ground, you trip. Now let's talk about the next big distortion, the one I promised to tell you about. Everyone is so focused on the Silicon Valley impact of AI that they are completely ignoring the Rust Belt impact, not just in America, but globally. There's a massive mismatch between the labor that AI will displace and the capital that is being invested. We are going to see a huge surplus of human labor in sectors like insurance, basic legal work, and customer service. At the same time, we have a massive shortage of blue-collar labor, the people who actually build and maintain the physical world. The distortion is this: the market is currently pricing white-collar human capital as if it's still scarce, and blue-collar physical infrastructure as if it's a commodity. It's the exact opposite. A mid-level lawyer is about to become a commodity. A master electrician who knows how to wire a data center, that guy is now a scarce asset. If I were starting over today, I wouldn't go to law school. I'd buy a fleet of service trucks and start an electrical contracting firm focused on high-density power environments. I'm seeing a world where the value of the physical is going to skyrocket while the value of the virtual is going to get crushed by its own abundance. This is the ultimate contrarian play. While everyone is trying to figure out how to invest in the cloud, I'm looking at the dirt, I'm looking at the copper mines, the power plants, and the specialized construction firms that have the moat of expertise and licenses. Those are the companies that will have the real pricing power. And what about free cash flow? If you're an AI software company, your capex is insane. You're spending billions just to stay relevant. Your free cash flow is often a fantasy. But if you own the bottleneck assets, your capex is relatively stable and your margins are expanding because your customers are desperate. That's the sweet spot. I've always preferred being the landlord to the gambler. The gambler might hit the jackpot, but the landlord gets paid every month, win or lose. You also have to consider the demographics. The younger generation is moving into a world where truth is becoming harder to verify because of AI. This is going to create a massive premium for trust and brand. In real estate, that means the branded assets, the premier buildings and the premier locations, will hold their value much better than the anonymous commodity stuff. Trust is a barrier to entry. If I know that when I lease space from an equity branded company, the lights stay on, the security is real, and the contract is honored, I'll pay a premium for that. In an AI distorted world, reputation becomes the ultimate liquid asset. Most people don't have skin in the game anymore. They are managing other people's money, and they are more worried about their tracking error against the S&P 500 than they are about the actual risk of the investment. That's why these bubbles get so big. It's other people's money syndrome. When you're playing with your own chips, you look at the world differently. You don't care if you miss the first 20% of a rally if it means you avoid the 80% crash. I've been called a cynic, a vulture, a grave dancer. I don't care about the labels, I care about the results, and the results come from a relentless focus on the fundamentals. Is the supply increasing? Is the demand sustainable? Can I buy it for less than it's worth? If you can answer those three questions with no, yes, and yes, then you have a deal. If not, walk away. There will always be another deal. The hardest thing to do in a hype cycle is nothing, but sometimes nothing is the most profitable trade you can make.